my friends, welcome on our webinar about indicators and oscillators. This is another webinar in our series of course, trading webinars. We started with the basics and then we slowly moved to more advanced stuff. And today, basics about indicators, because we didn't talk about indicators before, maybe just a little bit. Personally, myself, I don't use indicators. I use pure price action trading. Wait, I'm gonna close this and I will show you my platform. So I don't use indicators. I use pure price action trading, but of course I know how to use indicators. I was using them for a long time, and actually I'm creating trading robots, and most of the trading robots, if not all, are based on indicators. So I know a lot, if not everything about those indicators, how to use them properly. Because again, it's not a rocket science, and I will make it easy for you and hopefully enjoyable, and really you will understand how indicators work, why they behave like this, etc. And theory, like all the indicators are based really on the price movements. Okay, some of the indicators are leading indicators, so they are showing you the signal which can happen, movement which can happen in the future, but most of them are lagging indicators, so they are showing signal when it's already too late. Like for example, I mean not too late but late, like for example moving averages, which show you trading signal after this reversal or this big movement started, depending from the time frame. It can be more lagging or less. But the fact is that moving averages and most of other indicators are lagging indicators. And with moving averages, we will actually start. Just let me open like a fresh chart, maybe S&P 500. Why not? As you can see, price is dropping today. I do have a template for you, and let me show you indicators. Insert indicators. You have trend and you have moving average. We're gonna start with really basic moving average. So here you have parameters. This is period. So how many candles, how many periods is included in this moving average? And overall, moving average smooth the price. Okay, smooth the price movement shows you the average price from the previous periods as moving average. So you can type the different periods, like for example 5. This is short-term moving average. This is fast moving average. You have like 50, which is medium range moving average, and you have like 200, which is long-term moving average, and it's like a golden moving average for the trend change. Also, we have different methods of calculation. Simple, exponential, where the bigger influence is on the last price, and simple, all the weight is in the equal for all the periods, but an exponential is biggest weight in the latest prices. Smooth and linear weighted, mostly people use simple moving average or exponentials, and you apply it to close. Color can be like this. So this is 200, and you can see that 200 really should correspond with the price, and it does. But for example, when the direction changes in this moving average here, okay, the direction changes here. So till here, the moving average is going down, which is showing you a negative trend, let's say. direction changes here, where the trend already changed, like trend changed here, but 200 moving average changes the direction here. There are different ways to trade moving average. You can trade the direction change of the moving average, or you can change crosses. You can change crosses of the moving average with the price, and you can trade crosses of different moving averages. First, let me show you different moving averages. So indicators, trend, and moving average again. That was 200. So let me show you midterm. Let's have red. You can see that it moves more closely to the price. Okay, so here the trend change of this candle is of this moving average is here. Let's go like this, and the real trend change started here. So it's pretty fast, to be honest with you. But this is 50. We have another one. We have short-term moving average. Let's say 5. Different color. It moves exactly like the price, almost. Okay, so you have the first way to trade moving averages when they change the direction. For example, here, this 50 works like a charm, because here you have a sell signal, here you have a buy signal, here you have a sell signal here. 3 great trades. Splendid, really. Then you have another way to trade moving averages. For example, you can trade crosses, and the crosses, when the fast one, in this case 5, black, crosses the slow one, in this case blue or red one, it doesn't matter. When it crosses it from the top and goes below, it's a sell signal. So here. On the other hand, when the slow one crosses, when the fast one crosses the slow one from the bottom and goes to the top, it's a buy signal. Like here, like here, like here. You can see that here those signals would be really bad, because straight away the price drops below. The thing is that every currency pair has different volatility, and you need to have different set of moving averages in order to adjust to the instrument. Also, the thing is that you have different times, you have different periods of market volatility. So, for example, you can see this is H1 chart, but here we do have a sideways trend. And the thing is that in sideways trend, moving averages do not work properly. On the other hand, here you have a trend, you have a clear trend. And in trends, moving averages work perfectly. So, hint of the day. If you want to use moving averages, make sure that you use them on volatile instruments, that you use them on trending instruments, that you are avoiding using moving averages in sideways movements in non-trending market. Because for non-trending market, you have different instruments which are reliable. You don't use moving averages and during the time when the market goes sideways. Another way how you can use moving averages is when the price breaks the moving average. So for example, here price breaks from the bottom, goes to the top, that's a buy signal. But of course, it's another way, but the same would you would get if you would use moving average, but for example from 2 periods, yes, or from 1. You can see it's even better adjusted. So it's really like the price, yes. 2 periods is really like the price. So when the slow one crosses when the fast one crosses the slow one from the bottom, it's a buy signal. Also, another way how traders use moving average is they use them as support or resistance, and in particular they use 200 periods. Look at this, resistance. After resistance here, after the breakout, support. Here, kind of a support. Here, kind of a support. It's not the best way to trade, but at some point it gives signal about the direction. Like, for example, traders very often trade the breakouts of 200 moving average, 200 periods moving average. When the price crosses it from the top, it's for them a sell signal. When it crosses it from the bottom, it's for them a long-term buy signal. And long-term, because you use long-term moving average. Simple as that. So this is 4 ways how we can trade moving averages. So first of all, the direction change. Then you have cross of moving average and the price. Then cross of two moving averages, and then you can trade them, treating them as a support or resistance. And now it's up to you to decide if you will use 50, or maybe this instrument works better with 44. You can see the change. Or maybe this will work better with exponential. You can see how it changed. It's also a 44, but exponential. Simple. And exponential is different. So it is really versatile trading instrument, let's say. Okay, let's remove all the objects. Now let's move on to oscillators, because this is an indicator. Let's move to oscillators now. Okay, indicator, last moving. So I told you that moving averages, they work excellent in trends. What happens in the sideways trends when there is no trend, when there is no clear uptrend, no clear downtrend? Well, you use oscillators. Oscillators you can also use in trends to find the end of the trend, to find the divergence. And I bet that there is a divergence here, so that's why I'm going to save this chart, or there is a divergence here. I'm going to save this chart to show you this divergence. So again, indicators. The most popular indicators for divergences is MACD and RSI. First, MACD. MACD shortcut is moving average, convergence, divergence. How do you trade them? You can see that moving average, again, there are a few ways how you can trade MACD, but I'm gonna just show you one which is the most reliable. You have a histogram. Those bars, these are bars, but you have to make like you will see it's a bar. Yes, those are bars. They mimic the price in general. Okay, so look at this. You have a small top, there's top here. You have a top here, there's a top here. You have a bottom here, there's a bottom here. You have a top here, there's a top here. When the divergence happens is when the price is making lower low, but the indicator is not making lower low. Also, when the price is making higher high and indicator is not making higher high. Let's see. There's a low here and there is another low. That's a lower low. Low, lower low. What the indicator is doing is not making a lower low, it's making higher low. This is a divergence, it's a buy signal. In theory, it should be triggered here when the price is breaking the dynamic resistance. The same goes here. There is a top, there is another top, higher high. There is a top in MACD, there is a top in MACD here, which is lower. That's a divergence. The neckline for this double top is here. So breakout of the support gives us a sell signal, and so far so good. You can see that the signal is excellent. This is MACD. Another example here, I could show you triple bottom or double bottom, but the thing is that the proper double bottom, the second one, has to be lower than the first one. Okay, or here, this should have been lower and this lower. But for example, here, upswing, top, top, and we have a divergence. Actually, let me change the time frame, because I want to show you how it works. Like, for example, what's that? That's a COVID crash, right? Here I had a support, top, higher high, top, lower high. That's a divergence. Just using this technique, you could open short position here and a drop. You didn't have to be like crazy about all this news. Just follow the price. Another one, top, top, higher high, top, higher high. This is the neckline. What's MACD doing? That's a divergence. That's a sell signal. When is the sell signal triggered? Here. What's the profit? Amazing. Okay, my friends, this is MACD. I guess it's pretty clear. Let's remove all the objects. We don't need them. Those were moving averages and MACD. Actually, this is S&P 500, and you see that it works. Why not to move to the Forex market? Because I will show you that it also works. But the next indicator is RSI. RSI is Relative Strength Index, is one of the most popular indicators, is one of the most popular oscillators. And this is also used for divergences, but this is also used to show you the oversold and overbought status of the market. You can see that there are two lines here, 30 and 70. Yes, they are important, 30 and 70. And now, the area below 30 means that the market is oversold. So when the market is oversold, when it goes back above 30, that's a buy signal. On the other hand, price above 70 means that the market is overbought. So price going above 70 and going down means that there is a proper sell signal. That's just a random chart. I didn't prepare you a chart to show you that it works perfectly, because it's not my intention. And my intention is teach you working techniques. If it doesn't work, then it doesn't work. We are about to find out. This is one of the most popular indicators used by millions of traders. So let's see if in this particular time frame, which is several weeks, because one period here is 1 week because it's H4 chart, if during those several weeks since the beginning of September, if it worked. In order to do that, we need to highlight the areas. So here is some like this. So here is a buy signal. Here is sell signal. Let's see. Here is sell. Here it also goes above, as you can see, 71 and drop. So here is a sell signal. Okay, it doesn't have to be like precise. We are just checking something. Here is a buy signal. Here is a buy signal. And here is a sell signal. And here is a buy signal. Here is a buy signal. And here is a sell. And here is a sell. And here is a sell. Let's see. This is buy signal here. it goes towards here, buy signal here, and here is a signal to sell. So this is profitable, yes, because you buy here, you sell here, you buy here, you sell here, more or less, guys. Here you have a sell signal, here you have a sell signal again, and you close your short position here. So you open here, and you close it here. That's also a profit, even two profits, here and here. And here you buy, here you buy, here you buy again, and you close it here. So here you are buying, here you are buying, and you're closing it here. That's profit again. Yes, because you bought here because of this, then you bought again here because of this, and then you close it here because there is a sell signal here. Beautiful. So you sell here and you buy here. You sell here, you buy here. Profit again. You buy here, you sell here. You buy here, you sell here. That's a profit again. And now you sell here, you sell here, you sell here. Here, here, here. And here, so far, you are on loss. But I have to tell you that even I'm pleasantly surprised about how this indicator works. But again, that's a sideways trend, really. Look at this. The price now is like it was 2 weeks ago, 4 weeks ago, 5 weeks ago, 8 weeks ago, 9, 10 weeks ago. More or less, we are moving sideways from this resistance to this support. Inside, now you probably don't see anything on this chart, me either. But I'm explaining it on the go, and I guess you are following. The price is moving sideways, so oscillators work, and that's what I told you before. They do work in a sideways trend. Beware of using indicators in a downtrend, in a proper trend, like here. Let's check. Let's check here to show you. So you sell here again. So you sell here, or I will go straight away. You sell here, and then you sell here again because there is this, and then you buy here. From here to here. That's profit. Okay, that's a profit. And then you buy here. You buy here, you buy here again, you buy here again, you buy more, and then what's the RSI here? 69. You still don't sell. You buy again here. You buy again. So you have like 10 long positions, which you close here, because here you sell, here. So from here, you buy. I'm gonna show, this is of course loss. This is a huge loss. I will show you places where we should buy, where we were buying. So here, let's change the color into a black one, for example. And we bought here, and we bought here again, and we bought here, and we bought here, and we bought here, and we bought here, and we close our position here. You see, this one was on profit. This one was small. Those three were on a big loss. It depends how many positions did you open. Maybe you finished it on zero, maybe on a small loss. definitely not on a win. That's the problem of using indicators and the oscillators in the proper trend. Let's change. Maybe we can use Brent oil, for example. We used index, we used forex instruments or currency pair, and now we will use commodity. And the last indicator I will show you is CCI. That's another indicator, a very popular one. CCI is Commodity Channel Index, used mainly for commodities at the very beginning. And now it has different lines, minus 100 and plus 100. But you trade it similar to RSI. So 70-30. So here is the market is oversold, here is overbought, and you buy and sell here. Everything is the same, so maybe I'm gonna show you the last one really, which is super popular as well, which is stochastic oscillator. And stochastic is like RSI, but it has 80 and 20 instead of 30 and 70. So here is oversold, where you should buy. Here is overbought, where you should sell. And the principle is the same. And you also can use it for divergences, right? Like for example here. There's a divergence here, there is a divergence here. That was a buy signal. Here it was a buy signal. It was really good buy signal, by the way, because it's an inverse and shoulder formation. Here is the neckline. Maybe neckline would be better if it would be decline. So here, inverse and shoulder formation here was an amazing buy signal. Amazing. I mean, short-term buy signal on oil, but we are still higher than we were before. Anyways, my friends, you have a lot of indicators, really, a lot of indicators, oscillators like on balance, volume, money flow index, accumulation, distribution, and all that stuff. Many of them work really. Many of them are really similar to each other, and they work in a similar way. Check them, put them on the chart, try them, analyze them, and I'm sure you'll find your favorite indicator or oscillator if you really need them, because sometimes you may want to be a price action trader like myself, so don't use any indicators and you can be fine with that. Why not? My friends, thanks very much for watching our webinar, and see you on Thursday. On Thursday we have another webinar. I will talk about Ichimoku, so really powerhouse of the indicators, a lot of indicators, a lot of knowledge in one place, a lot of trading signals. So my friends, thanks very much and all the best in your trading.